Hi everyone, welcome back to this week's Beyond the Markets. We have plenty of interesting stuff to cover today, so let's dive straight into it. Our first topic of the week is Trump's tariff reaction. The global trade war is heating up once again, and this time it's a direct response to President Donald Trump's latest tariffs on steel and aluminum imports. Major economic powers, including Canada and the European Union, are hitting back hard with billions in retaliatory tariffs. Let's break down what's happening, how it affects global trade, and what this means for the economy going forward. As of Wednesday, a 25% tariff on all imported steel and aluminum into the United States has officially gone into effect. Trump first announced the measures in early February, stating that it's a big deal and will help bring back American industries. While domestic steel producers have welcomed the move, the response from key trade partners has been anything but supportive. Retaliatory tariffs were announced. Canada strikes back. Let's start with Canada. After weeks of diplomatic tensions and back and forth threats, Canada has unveiled its own set of tariffs, totaling approximately 21 billion US dollars in American goods. Here is the breakdown. $8.8 billion on steel products, $2.1 billion on aluminum products, $9.9 billion on other US imports, including consumer goods and food products. Finance Minister Dominic LeBlanc has made it clear these tariffs will go into effect immediately and will remain until the US reverses course. But Canada isn't the only one taking action. The European Commission also announced it will be rolling out its own countermeasures. By April 1, existing trade penalties against US goods will be reinstated, and by mid-April, additional tariffs will target up to $28 billion in American exports. The EU is strategically focusing on products like steel, aluminum, textiles, and agricultural goods, many of which come from Republican strongholds in the south of the US. One of the most shocking developments came when Trump floated the idea of doubling the steel and aluminum tariffs on Canada, raising them to 50%. However, this was quickly reversed after negotiations between Ontario Premier Doug Ford and US Commerce Secretary Howard Lutnick. Ford agreed to suspend a 25% tax on electricity imports from Ontario to US states like New York and Michigan, which led Trump to back down. Unsurprisingly, this trade war escalation is already having ripple effects across the markets. Steel and aluminum stocks in the US saw an initial boost, while companies reliant on imports are facing pressure. Meanwhile, international markets reacted negatively, with European and Canadian stocks showing declines in industries directly affected by these tariffs. $21 billion, that's the total value of US goods affected by Canada's countermeasures alone. And when you factor in the EU's upcoming $28 billion tariffs, the overall impact on the American economy could be substantial. Our second topic is the Indian Ocean chessboard, US, China, and India's power struggle over Diego Garcia. The Indian Ocean might not make headlines every day, but it's at the center of one of the most critical geopolitical battles of our time. At the heart of it, a tiny island called Diego Garcia, home to a US-UK military base, and now a key piece in the power struggle between the US, China, and India. Why Diego Garcia matters. Diego Garcia is a remote atoll in the Chagos archipelago, controlled by the UK but leased to the US since the 1970s. The base allows the US to protect military power across the Indian Ocean, from the Middle East to Southeast Asia. Some even argue it's as strategically vital as Panama or Greenland. But now, the base's future is uncertain. The UK agreed last year to return the Chagos Islands to Mauritius, a move that is supported by India, but Washington fears could open the door for China to expand its influence. Over the past decade, China has rapidly increased its military and economic footprint in the Indian Ocean. It has secured access to ports across the region, from Mozambique to Australia. According to the Council on Foreign Relations, 36 of the 46 commercial ports China has built in the region are capable of hosting naval assets. China has also established its first overseas military base in Djibouti, giving it a strategic foothold near key maritime choke points. In 2022, a Chinese surveillance vessel docked at the Sri Lankan port, raising alarm bells in New Delhi. India, viewing the Indian Ocean as its backyard, has been stepping up its efforts to counter China. It has developed an airstrip on Mauritius' Agalega Islands, aimed at monitoring Chinese activity. New Delhi has also deepened ties with island nations through infrastructure projects, military bases, and economic aid. But India has struggled to keep up. It failed to secure a base in the Seychelles and has faced setbacks in Bangladesh and the Maldives, where pro-China governments have taken power. On the other hand, the US wants India to take the lead in countering China's influence. The Trump administration even supported deeper defense ties, including potential F-35 fighter jet sales to India. But there is still uncertainty. The US is upgrading its embassy in Mauritius, signaling a long-term commitment. Yet, its future in the region hinges on maintaining Diego Garcia as a strategic hub. At the center of this great power rivalry are small island nations like Mauritius, which now have a choice: align with India in the West or deepen ties with China. As tensions rise in the Indian Ocean, one thing is clear: Diego Garcia is no longer just a remote island, it's a critical piece in a global chess match. Now, let's take a look at a few charts. Every week, we look at the straddle price and discuss if selling it last week would have been profitable if held till expiration. The straddle price gives us a pretty accurate estimation of what the market makers want to receive to sell this volatility, and as such, how wide they expect the market to go up or down at most. If you would have opened a 7 DTE short straddle last week, you would have generated a profit of $178 this week. Volatility was quite expensive last week, which showed that the market makers expected another volatile week, and that's what we had. Now, let's take a look at the S&P 500 ETF, SPY. SPY had another volatile week. The SPY closed the week down 2.28%, closing at $562.81 per share and reaching a high of $596 and a low of $549.68 respectively. The SPY is in a strong downtrend and breached its 50-week exponential moving average for the first time since October of 2023, after which we saw a significant rally. Will it be the same this time? That's a big question investors are currently asking. When we take a look at the open interest, we still see significant open interest on the put side. While last week there were very notable blocks on certain put strikes, this is now not the case. Overall open interest in puts is very high, much higher compared to the call side. This week, we have the monthly option expiration for SPY, which means that it will more than likely be another very volatile week, especially when we get close to expiration. The straddle this week is priced at $13.52, which is slightly lower compared to last week, but still very elevated. Once again, selling the straddle could potentially be very profitable this week, as significant volatility is priced in. This gives us an interval between 549.29 and 576.33 for the straddle to be profitable. Max Pain, on the other hand, currently sits at around $584 per share for the expiration next Friday. The Nasdaq, on the other hand, closed the week down 2.46%, pretty much in line with the SPY. The NDX reached a high of 19.87k and a low of 19.15k this week, which shows it was quite a volatile week intra-week. We closed below the 50-week exponential moving average, which shows we are in a potential downward trend right now. We need to reverse relatively soon to avoid a deeper bear market in the Nasdaq. The Russell closed the week down 1.6%, reaching 2.044k. The Russell is still in shambles, down already over 17.5% from its all-time high. The small cap index lost less this week compared to its more tech-heavy counterparts like the Nasdaq and the S&P, and is still hovering around that 200-week exponential moving average. The big question now is, will it soon be time for small caps? This week was kind of promising as the small caps dropped less compared to its tech-heavy counterparts, but still, the Russell has been a very painful hold over the past few months if you had it in your portfolio. Hopefully it will be time for them soon. I want to thank you for watching and subscribe down below, and see you next week. Bye bye.